So, you want to learn bookkeeping. Payroll. By Dave Marshall. Basic Payroll. Introduction. Many businesses begin operations as a sole proprietorship business owned by one individual. The owner often starts out as the only person performing all the tasks necessary to running the business, such as planning, purchasing, selling, bookkeeping, and handling the day-to-day operations. In other words, we got a chief with no Indians. Some not only start out, but continue to operate as a one-man or woman show without the need for any employees. The one-person operations are content in the income they can produce on their own from providing their product or service and may not want the hassle of employees. On the other hand, we're all probably familiar with the saying that many hands make light work. As the business grows, however, even the sole proprietorship is often faced with the decision of obtaining additional help. The additional help can be obtained in the form of employees, temporary services, or contracted services. If the business outsources, uses temporary help or contracted services exclusively, any special government requirements and payroll knowledge and procedures related to employees is avoided. All U.S. businesses must have a taxpayer identification number. The two most common types of taxpayer identification numbers are your Social Security number (SSN) or an Employer Identification Number (EID). A Social Security number is issued by the Social Security Administration, while an Employer Identification Number is issued by the IRS to sole proprietorships, individuals, partnerships, corporations, limited liability companies, and other entities. Who are employees? According to the IRS, a person performing services may be classified as an independent contractor, a common law employee, statutory employee, or a statutory non-employee. In general, if an individual is not classified as a common law employee, you are not required to collect and report payroll deductions and taxes. Let's first look at who is not an employee. Independent contractor. Examples of independent contractors include lawyers, accountants, and contractors who work in an independent trade, business, or profession that offers services to the general public. As a general rule, if you employ an individual or firm and you only have the right to control the results of the work, but not the methods, means, and procedures used to accomplish the work, the individual or firm is classified as an independent contractor. Statutory non-employee. By law, statutory non-employees include individuals engaged in direct selling, companion sitters, and licensed real estate agents. Why? Just because that is the law. Their services are performed under a written contract providing that they will not be treated as employees for federal tax purposes. Well, we briefly discussed who's not an employee, now let's see who is. Common law employee. In general, anyone who works for you where you can control what and how the work is performed is treated as your employee and you are required to collect and report payroll deductions and taxes. Statutory employee. By law, certain types of work performed are treated as employees regardless of any other general guidelines that may be used to determine employee status. Why? Again, just because that is the law. What do I need to do when hiring employees? You need to perform the following tasks. Of course, you're going to need to set up your payroll system so that you can track your employees' wages and deductions and remit all the necessary payments required by the IRS. In addition, you'll need to design or obtain the forms such as employment applications, employee reviews, employee deduction authorizations, layoff slips, etc. needed to administer your payroll system. Determine your pay periods. You need to decide how often you are going to pay your employees. Weekly, 52 paychecks per year. Semi-weekly, every other week, 26 paychecks per year. Bi-monthly, twice a month, 24 paychecks per year. Monthly, 12 paychecks per year. Annually, 1 paycheck per year. You should register with your state's employment agency or department for payment of state unemployment taxes. Obtain workers' compensation insurance. This insurance provides benefits to your employees who suffer an on-the-job injury. Determine what federal and state labor laws apply to your business. Check out the Department of Labor's DOL's website in your applicable state's labor department. Check to see if any Occupational Safety and Health Act (OSHA) requirements apply to your type of business using OSHA's website for help and information. Determine, obtain, and post all the labor posters required for your business. Determine what, if any, fringe benefits you plan to provide your employees and any applicable laws and regulations. Report all new hires to your state's new hire reporting agency. This agency's purpose is to help track down parents who owe child support. Fill out Form I-9, Employment Eligibility Verification for each employee hired. Have all employees fill out IRS Form W-4. Fair Labor Standards Act. The Fair Labor Standards Act, FLSA, applies to employees of enterprises that do at least $500,000 in business a year. It also applies to employees of smaller firms if the employees are engaged in interstate commerce. The Act, FLSA, establishes minimum wage, overtime pay, record keeping, and child labor standards affecting full-time and part-time workers. The FLSA requires you to classify all of your employees as either exempt or non-exempt. You use the rules set out by the law, FLSA, in order to determine whether an employee is exempt or non-exempt and whether you have to follow special rules when paying some or all of your employees. Note: states also have laws and regulations governing how an employee must be paid. If a state's laws, rules, are more beneficial to an employee than the FLSA laws, rules, then you must adhere to your state's labor laws. Classifying your employees. Exempt, non-exempt employees. Exempt employee requirements. Basically, to qualify as an exempt employee, the employee must 1. Be paid on a salary basis, 2. Perform exempt job duties, and 3. Earn a salary of at least a weekly amount set by the law. Effective January 1, 2020, the minimum salary level to be exempt is at least $684 per week, $35,568 per year. Non-exempt. An employee who is not paid on a salary basis is non-exempt no matter what kind of work he or she does. Note: being paid on a salary basis does not automatically classify an employee as exempt. Non-exempt employees may also be paid on a salary basis. An employee who is paid on a salary basis is exempt only if they meet the exempt employee requirements stated above. What does exempt mean? The term used in your daily life means that you don't have to do something. It also has the same meaning when used in conjunction with the FLSA. If an employee is determined to be classified exempt from the FLSA, it means that you as an employer are not subject to any of the FLSA special rules for this employee and the employee is not entitled to any of the FLSA protection and benefits. This means that an exempt employee does not have to be paid overtime for hours worked in excess of 40. If you want to be able to classify an employee as exempt, you must pay him or her a salary. Most employers are well aware that employees must be paid on a salary basis to be considered exempt from the overtime requirements of the Fair Labor Standards Act, FLSA. This means employees must receive the same amount of pay each week regardless of the amount or quality of work they perform for a given week. Accordingly, exempt employees must be paid their full weekly salary for any week in which they perform work, whether or not the employee has actually worked a full work week. What does non-exempt mean? Non-exempt is the exact opposite of exempt. It means you have to do something. If an employee is determined to be classified as non-exempt from the FLSA, it means that you as an employer are subject to all of the FLSA special rules for this employee and the employee is entitled to all the protection and benefits provided by the FLSA law, such as minimum wage and overtime requirements. Any employee not paid a salary, hourly rate, piece rate, or commission, is automatically classified as non-exempt. However, as stated earlier, you can have non-exempt employers that are paid a salary. So, you want to learn bookkeeping. Payroll. By Dave Marshall. Basic payroll. Types of compensation. Employee compensation. Employee compensation includes not only direct payments made to employees for work performed but also any benefits indirectly paid on behalf of the employee. The employee's compensation includes not only cash paid to employees but basically anything of value. As a general rule, all types of compensation paid directly or indirectly to an employee is subject to withholding and employment taxes. The IRS does allow an employer to provide some benefits that do provide favorable tax treatment to the business as well as to the individual. I've grouped an employee's total compensation into 4 categories: regular, additional, employer-provided benefits, benefits provided by law, regular compensation. This is what the employer and employee agreed would be the employee's regular pay for the services they provide. Common types of regular compensation are salaries compensation based on a fixed amount and normally paid to an employee for management, professional, administrative, or similar services, exempt type of jobs. Wages compensation based on an hourly or piece work rate for either skilled or unskilled employees. Commissions compensation based on the employee's productivity, usually stated as an amount per sale or as a percentage of each sale. Most commissions are related to selling positions. Overtime premium pay for working more hours than normal during a pay period. Shift differentials incentive used to attract employees to work during hours that employees would normally prefer not to work. Paid breaks employer pays the employee for the time spent on breaks or rest periods. Additional compensation. Compensation that may or may not be paid to employees based on goals, rules, and regulations determined by the employer or as a customary practice of the industry. Tips extra earnings voluntarily contributed by customers. Bonuses and profit sharing extra compensation usually based on meeting or surpassing some company set goals. Employer provided benefits. Fringe benefits or perks. These type of benefits are normally not paid in cash or included in the employee's paycheck. However, they are a major cost for most employers' businesses. Why pay them? Good employees are one of a business's key assets. Hiring and retaining good employees is a constant challenge. What are some of these other benefits? Some common provided benefits. Vacation is days off provided to employees to relax and get away from work. Holidays are days off for special occasions that the employer provides to employees. The days off can be with or without pay. Sick and personal time is time allowed due to sickness or illness, funerals, jury duty, doctor or dentist appointment, military obligations, etc. This benefit can be with or without pay. Health insurance provides coverage payments for the employee and or his or her family for medical expenses when a person is sick or injured. The employer can cover the full cost or require the employee to also contribute to the cost of providing this benefit. Group term life insurance and or disability insurance provides payments to the employee or surviving family if the employee dies or becomes disabled. The IRS has some special rules related to this type of benefit. Retirement provides a plan to help employees accumulate savings for retirement. Plans may or may not require the business employer to contribute to the plan. Most retirement plans are required to follow strict rules and regulations pertaining to eligibility, discrimination, and limits on benefits and amounts contributed. Some other fringes an employer may provide: dependent care, continuing education, employee discounts, stock options, parking, athletic facilities, meals provided for employer convenience, cafeteria plans, benefits provided by law to employees. These benefits are provided by the employer or a combination of employee and employer contributions. Workers' compensation insurance, a benefit that provides payments to employees for injuries suffered on the job. Only the employer is required to contribute premiums for this coverage. State and federal regulations require most businesses to provide this benefit. Unemployment compensation, a benefit that provides payments to laid off or ex-employees during times when they are not employed. The employer is normally required by law to make payments not only to their state but also to the federal government. Social Security (FICA) and Medicare, a certain percentage is deducted from an employee's pay for FICA, Federal Insurance Contribution Act, and Medicare taxes. The employer is required to pay the same amount as the amount deducted from the employee's wages for these two taxes. In other words, the employer pays half and the employee pays half of these employment taxes. Many employees, or for that matter employers, don't understand exactly what those FICA and Medicare deductions are and what they do and don't provide to covered employees. Basically, Social Security deductions (FICA) are for providing some employee retirement benefits, and the Medicare deduction is used to provide future medical benefits. So, you want to learn bookkeeping. Payroll. By Dave Marshall. Basic payroll. Types of deductions. Payroll deductions. An employee's pay is one area of a business that has no tolerance for errors. Not only must you properly calculate the employee's earnings but also properly calculate all the deductions that apply to your employee's earnings. What many employers may not realize is that federal and state laws may apply to what and how much can be deducted from an employee's pay. For employers that offer and provide a lot of fringe benefits to their employees, many of the deductions from an employee's wages are directly related to the fringe benefits. In many cases, the employer pays a portion of the cost and the employee also is required to pay a portion of the cost. The employee's portion of the cost is normally deducted from their wages. Deductions from pay. Basically, deductions from pay can be classified into three categories: deductions required by law, deductions for the employer's convenience, deductions for the employee's convenience. Required by law. Social Security mandatory contributions to the federal retirement system. The Social Security deduction is calculated as the employee's gross earnings times 6.2%. For 2020, incomes over $137,700 that have already had the maximum Social Security amount of $8,537 withheld will not have any additional Social Security withholdings. Medicare mandatory contributions to the federal medical system. The Medicare deduction is calculated as the employee's gross earnings times 1.45%. Unlike Social Security, there is no annual limit to Medicare deductions. Income tax withholdings: pay-as-you-go deductions for income tax. The IRS supplies approved tables, methods, and instructions on calculating how much should be deducted from an employee's pay. State income tax withholdings: pay-as-you-go deductions for state income tax. Most but not all states have a state income tax. State taxing authorities supply approved tables, methods, and instructions on calculating how much should be deducted from an employee's pay. Local income tax withholdings: pay-as-you-go deductions for local income tax. Some but not all local governments have a local income tax. The local taxing authority supplies approved tables, methods, and instructions on calculating how much should be deducted from an employee's pay. Garnishments and child support deductions to satisfy legal claims of others for unpaid obligations of an employee. Note: special rules and calculations are required in order to determine the amount of the allowable deduction. Tip credits allow an employer, when allowed by federal and state laws, to pay employees in tip-related occupations less than minimum wage. Note: if you're an employer in this type of industry, consult the applicable federal and state labor laws. Employer's convenience. Be careful on deductions that fall within this category. As a general rule, any deductions of this type cannot reduce the employee's gross pay below the minimum wage. Federal and/or state labor laws govern how much, if any, can be deducted from an employee's pay. You may not try to get around the law by having the employee reimburse the employer in cash for the cost of such items in lieu of deducting the cost from the employee's wages. All the following deductions, if authorized by the employee and they don't violate any federal or state laws, are normally an allowable deduction. Overpayments: errors made in calculating employees' wages. Tools required: tools necessary for performing the employee's job. Uniforms: deductions for uniforms required by law or the employer and any related cleaning of the uniforms. Shortages: deductions for cash or other shortages attributable to employees. Breakage: deductions for merchandise damage attributable to improper or careless handling by employees. Medical exam: deductions for employee medical exams required by employer or law. Drug test: deductions for drug test required by law or the employer. Employee theft: deductions for cash or merchandise shortages attributable to employees. Employee's convenience. Insurance: the employee's share of group life and medical and dental insurance. Advances: employee loans. Retirement plan: deductions for the employee's portion of contributions to employer-sponsored retirement plans. Union dues: deductions approved by employees that provide for the payment of the employee's union membership dues. Charity deductions. Employee savings accounts, U.S. bonds. So, you want to learn bookkeeping. Payroll. By Dave Marshall. Payroll taxes. IRS payroll tax and withholdings deposit rules. As most of you are probably already aware, the IRS requires employers to deduct Social Security and Medicare from their employees' wages and to match what is deducted from their employees' pay for Social Security and Medicare. Social Security is deducted from an employee's earnings at the current rate 2020 of 6.2% and Medicare is deducted at the current rate 2020 of 1.45% or a combined rate of 7.65%. The employer is also required to pay match 6.2% and 1.45% of an employee's earnings. In another lesson, we deducted these amounts when calculating our employees' pay. Taking the deductions is only half the battle. The other half of the battle is monitoring, filing the proper forms, and depositing these deductions. The IRS requires an employer to pay or deposit these taxes as you go. Since these taxes are deducted from an employee's earnings, reduce the amount directly paid to the employee has incurred an unpaid liability to the IRS on behalf of his employees. Additionally, the employer has also incurred a liability to the IRS for his employer's share. These amounts can build up fast and become substantial liabilities if not paid at regular intervals. IRS Publication 15 provides detailed instructions and guidance on payroll taxes and tax deposit requirements. I've tried to simplify and summarize some of the main rules and requirements in order to give you the basics in a nutshell. Normally, a business must periodically deposit income tax, Social Security and Medicare withheld from employees' wages along with the employer's matching contribution for Social Security and Medicare in an authorized financial institution or use the electronic federal tax deposit system. A payroll tax deposit is comprised of the federal income taxes withheld from your employee's wages and both the employee and employer portions of Social Security and Medicare taxes. Businesses that have quite a few employees normally are required to make periodic deposits of payroll taxes and withholdings based on a determination made at the beginning of each new calendar year. The two methods of making deposits are 1. Monthly and 2. Semi-weekly. The determination involves determining what the liability was for what the IRS refers to as the look-back period. If this liability is less than or equal to $50,000, the monthly scheduled deposit rules are used. Otherwise, the semi-weekly deposit rules are used. Deposit rules. You must make all federal tax deposits using electronic funds transfer, generally by using Electronic Federal Tax Payment System, EFTPS. EFTPS is a free service provided by the Department of Treasury. Forms used to report IRS taxes and withholdings. As I stated earlier, not only does a business have to pay or deposit these deductions as they go, but periodically they must also file forms that summarize and report the information about these deductions. Form 941 is filed each quarter to report and summarize the deductions made from your employees' wages and the deposits made to the IRS for these taxes and withholdings. Penalties for not filing timely can be quite steep. Unemployment taxes. Most states have payroll taxes that are normally only paid by the employer and are used to accumulate funds for paying employees when they are unemployed. The federal government also collects these taxes and uses the money to administer the unemployment programs. If your business has any employees, you will normally have to pay both state and federal unemployment taxes. Federal unemployment. If you have at least one employee for 20 calendar weeks during the current or preceding calendar year, or you pay at least $1,500 in wages during any calendar quarter in the current or preceding year, you are required to pay federal unemployment taxes. Form 940 is used to report and account for federal unemployment taxes. The report is filed annually and is due by January 31st. The taxes are calculated and deposited quarterly. They should be deposited by the last day of the first month following the end of a quarter. The federal unemployment tax rate is 6.2%, but this rate is reduced by a maximum of credit of 5.4% for payments made to your state unemployment tax fund. If your business qualifies for the maximum state credit, the rate used to compute your federal unemployment tax is 0.8%. Not only does a business have to pay or deposit these taxes as they go, but periodically they must also file forms that summarize and report the information about these taxes. State unemployment taxes. Normally, state unemployment taxes are imposed directly on employers and the business employer does not withhold these taxes from employees' wages. In most of the states, if you're required to pay federal unemployment tax, you're also required to pay state unemployment tax. Actually, all employers should check with their state to determine what, if any, special rules apply. The tax is usually reported and calculated quarterly, and the state supplies the forms used for reporting and calculating the tax. Normally, like the federal government, each state has a maximum wage amount on which the tax is imposed on each employee's wages. In order to calculate the tax, the state assigns a experience rating, for the business to use, normally based on their experience. In other words, if your business has a lot of layoffs, your assigned rate will be higher than if your business has relatively few layoffs. The state-supplied forms are relatively easy once you have the information assembled for making the calculation. For the quarter, you will need the total amount of wages paid to your employees and the amount of what is normally called exempt wages. Most small business owners don't want to fool with preparing these forms and have their bookkeeper or accountant prepare them for them. You should, however, at least be familiar with your deposit and reporting requirements and make sure that they are performed in a timely manner. So, you want to learn bookkeeping. Payroll. By Dave Marshall. Payroll records. One area of your business, even if you're a small business, where you must maintain good records is payroll. You need to dot your I's and cross your T's in order to comply with all the government laws and regulations and also to protect your business from employee lawsuits. Payroll forms. Employment application. The whole payroll process starts with your employment application. You should thoroughly check out your employees and any references supplied. In addition, you may want to even hire a service to do a background check. Some types of business are required to do a background check. Form W-4. Have all employees fill out IRS Form W-4, Withholding Allowance Certificate. This form provides the information necessary for properly withholding the correct amount of income tax from your employees' wages. Form I-9. Fill out Form I-9, Employment Eligibility Verification for each employee hired. This form is required and used to verify that every employee you hire is eligible to work in the United States. Payroll source documents. Timesheets. One type of document that a business can use to record and track their employees' time is called a timesheet. The sheet includes the date worked, regular hours worked, overtime hours worked, holiday, sick, or personal hours and any other information you need to properly record and calculate your employees' wages. Time card. Another basic document for recording the amount of time an employee works. The time card is used in conjunction with a time clock where the employee enters his/her card to clock in and out and the day and hour are recorded on the card. Other payroll source documents. Weekly tip reports for all tipped employees. Production piece rate report for production piece rate employees. Bonus report and calculation for employees entitled to a bonus. Commission report and calculations for employees paid based on a commission. Payroll general ledger accounts included in the chart of accounts. A payroll journal register is normally used as the record, special journal, that summarizes the payroll information by pay period and is used to post the summary totals to the general ledger. The payroll journal records the expense accounts where salary and wage gross amounts are charged. In addition, all the deductions taken from salary and wages are charged to the appropriate liability or expense offset account. Employee earnings records. In addition to our payroll journal, a detailed earnings record or subsidiary ledger is maintained for each employee. Summary earnings record. In addition to maintaining an earnings record for each employee, you should also have a summary earnings record that summarizes the total amounts of all your earnings record columns for all your employees. Forms W-3 and W-2. Of course, at the beginning of each new year, W-2s must be prepared and given to all your employees that worked for you at any time during the prior year. Do you recall where we get the information for completing the W-2s? The Employee Earning Records Right. Form W-3 is used to summarize all the amounts on all the employees' W-2 forms. Most of you are probably already somewhat familiar with the W-2 form. Payroll files. What do you do with all these payroll forms, documents, and records? You do my least liked business task, filing. We may not like it, but it's a necessary evil. You should maintain an employee file for each of your employees and keep it updated with copies of any forms and documents applicable to the employee. In addition, you should also maintain a company payroll file that includes a copy of any payroll forms, documents, and records required by governmental laws, rules, and regulations. This file may also include any general company payroll policies and procedures. Employee file. What are some of these employee documents? Employment application. Employee performance and pay raise reviews. Employment contracts and agreements relating to pay rates and work hours. Authorizations for deductions taken from wages that the employee approves. Employee's W-4 withholding allowance form. Employee's I-9 employment eligibility form. Attendance records. Job description. Accident and injury reports. Layoff slips if applicable. Reprimands. Awards and special achievements. Time cards and sheets. Tip reports if applicable. Commission reports. Earnings record. Bonus calculations. Garnishments. Employee contracts. Company file. What are some of these company payroll documents? Form 941 Quarterly Payroll Tax Reports. State unemployment reports. Form 940 Federal Unemployment Tax Reports. Workmen's compensation documents. Copy of Company Employee Manual if you have one. Job descriptions. Fringe benefits documents. Union agreements if applicable. So, you want to learn bookkeeping. Payroll. By Dave Marshall. Government regulations. Government laws and regulations. If you have read George Orwell's book 1984, you'll remember that the main theme is about Big Brother watching you and about rules and regulations. Well, our society's Big Brother is government at all levels from federal to state to local. While it's difficult to keep up with all the ins and outs, a basic familiarity with these rules, laws, and regulations is needed by most small business owners. What areas do some of these payroll-related laws cover? In prior lessons, we covered Social Security and Medicare that employees and employers are required to provide. In addition, we covered self-employment taxes that apply to certain types of business organization owners. These programs are governed by federal law. Employment discrimination law's purpose is prevent discrimination between individuals based on race, religion, sex, age, disabilities, or national origin. Federal and state law compose the main body of employment discrimination law. Most of us are familiar with the Equal Pay Act that basically prohibits paying different wages to individuals performing the same basic job. Another law administered by federal, Fair Labor Standards Act, and state laws that we are also familiar with is the minimum wage law that prohibits employers from paying employees less than this minimum rate per hour worked. The Fair Labor Standards Act is the federal statute that provides for a minimum wage and the payment of overtime. Many states also have labor laws pertaining to the payment of wages. State statutes may even provide greater employee protection than the federal law. The Family and Medical Leave Act, FMLA, requires all employers with at least 50 workers to allow qualified employees time off for attending to personal matters such as the birth or adoption of a child or caring for a spouse, child, or parent with a serious health problem. Unemployment insurance provide terminated workers with temporary benefits to help soften the loss of the earnings from their job and provide them time to find another similar job. Federal and state workers' compensation laws are provided to provide benefits and awards to employees and/or dependents for employees who are injured, killed, or disabled on the job. The main statute protecting the health and safety of workers is the Occupational and Safety Health Act, OSHA. Federal and state workplace safety and health laws are designed to have employers provide a safe work environment for their employees in order to eliminate injuries and illnesses from occurring in the workplace. Pensions are governed primarily by federal law. In order to encourage employers to provide pension plans that follow congressional guideline and law such as the Employment Retirement Income Security Act, ERISA, tax breaks are provided to employers who follow the guidelines. Although we don't hear much about unions anymore, they still represent an area that many employers still must deal with. The main body of law governing collective bargaining is the National Labor Relations Act, NLRA. This law grants employees the right to collectively bargain and join trade unions. So, you want to learn bookkeeping. Payroll. By Dave Marshall. Common payroll terms. Payroll. Payroll is the process of paying employees for work they performed for your business. Federal, state, and sometimes local laws govern how you do payroll, and to an extent, how much you pay and how often, meaning you can't make up all the rules as you go. The process also consists of withholding money for taxes and other employee expenses, not to mention paying your business employment taxes. Payroll deduction. A payroll deduction is money you withhold from an employee's earnings to pay for benefits, like insurance premiums, and other expenses, like taxes, garnishments, and child support. Pay period. A pay period is the time frame of work for which you're paying an employee. Common periods are weekly, bi-weekly every 2 weeks, bi-monthly twice a month, and monthly. Employer Identification Number, EIN. The EIN is a unique 9-digit number assigned to all employers that submit an IRS EIN application. It helps identify businesses as they file taxes, apply for business loans, and open business bank accounts. In summary, it's like a social security number for businesses and is a requirement for any business processing payroll. Gross pay. Gross pay is the amount of an employee's paycheck before payroll deductions are withheld. For hourly employees, this is their hourly rate multiplied by the number of hours they're being paid for the period plus any overtime, bonuses, and additional pay. For salaried employees, gross pay is their annual salary divided by the number of pay periods in the year plus bonuses. Net pay. Net pay is the final amount you pay your employees for their work, after all deductions have been made. Minimum wage. Minimum wage is the lowest hourly pay rate you're legally allowed to pay an employee. For the Department of Labor (DOL), the federal minimum wage rate is currently $7.25 an hour, but state rates vary. There are exceptions, such as those for minors and interns. Tipped employees are another group you'll find the law makes exceptions for. Overtime pay. Overtime pay is the additional hourly money you pay an employee in excess of their regular pay rate, usually for time worked over 40 hours in a 7-day period. Per federal law, these hours are paid at time and a half, or 1.5 times the employee's regular hourly pay rate. Shift differential. A shift differential is a premium amount that you can pay employees who work outside of normal business hours. For some companies, this is the overnight shift and on weekends. Employee. Employee sounds straightforward, but we do need to clarify, as you'll see when we review the next term, independent contractor. Employees are workers that are formally hired to fulfill a specific position within a company. Employers pay a reasonable wage and may offer benefits, especially if employees work at least 40 hours weekly. You must also pay and withhold taxes on employee earnings. In exchange, these employees must abide by company rules such as when and how to work. Independent contractor. Independent contractors are workers who are hired to perform a specific job or project. They're not employees, so they aren't protected by federal labor laws or the federal government's minimum wage requirement. Unlike employees, employers aren't allowed to dictate how or when contractors complete their work. Exempt employees. Exempt is a classification employers typically assign to employees who are paid on a salary basis versus hourly, although in some circumstances, hourly workers can be exempt. Exempt employees are not entitled to overtime pay. However, an employer may choose to pay exempt employees extra compensation in addition to their fixed salary without jeopardizing the exempt status. Non-exempt employees. Classification assigned to employees covered by the Fair Labor Standards Act. A non-exempt employee must be paid the minimum wage and overtime pay for any time worked beyond 40 hours in a given week. Under FLSA rules, non-exempt employees are entitled to time and 1/2 of their regular pay rate for each hour of overtime. Tipped employees. Employees who regularly receive more than $30 monthly in tips for their work. Federal law allows employers to factor tips into their hourly pay rate. As long as employee earnings are equal at least the federal and state, and local, if applicable, minimum wage rate, employers can pay $2.13 an hour. Paid time off. Paid time off, or PTO, is time your employees don't spend working but still earn a paycheck at their regular pay rate. It consists of any paid leave, i.e., vacation or sick time, and even jury duty and holidays. Federal law doesn't have strict guidelines or requirements regarding PTO. You choose whether you want to offer paid vacation time or not. State laws may differ. FICA taxes. FICA taxes are Social Security and Medicare taxes that the federal government charges on each employee's earnings. Employers must reduce employee paychecks by 7.65%, 6.2% for Social Security plus 1.45% for Medicare, and pay the money to the IRS. They also have to pay that same amount from their business funds. Unemployment taxes. Unemployment taxes are taxes employers pay out of their own money to fund their state and federal unemployment programs. New hire reporting. New hire reporting is a process employers undergo to report new hires to their state. Federal law requires that all new hires be reported within 20 days of their hire date. All information is stored in the National Directory of New Hires and helps child support agencies locate parents who owe money. Fair Labor Standards Act. You'll hear this thrown around quite a bit and also referred to as FLSA. It's a federal act that consists of numerous laws meant to assure that employees are treated well and paid fairly. The federal minimum wage and overtime rules fall under this act, as well as record-keeping rules and child labor laws. W-2 form. The W-2 form is a tax document that reports all employee earnings in addition to taxes and deductions withheld. Employers must send this document to all employees by January 31st following the year that's being reported. A copy should also be sent to the IRS and state tax agency, if applicable. The information provided helps employees complete their tax returns with accurate information. 940 Form. Annual form used to report and calculate federal unemployment taxes. 941 Form. Quarterly form required to report and calculate federal payroll taxes. Payroll Journal Register. Record used to summarize all employee earnings and deductions for each pay period. Employee Earnings Record. Record maintained for each employee that summarizes their earnings and deduction for each pay period.